everyone. Welcome to today's webinar. Today's topic is how to plan for taxes in retirement with Dana Anspach and Oscar Vivas. Dana's the founder and CEO of Sensible Money, and she's recognized as one of the nation's leading authorities on decumulation planning. She's the author of Control Your Retirement Destiny, the popular guide to decumulation planning, and you can also find this as a podcast on Apple, Spotify, and iTunes. Her online course, How to Plan for the Perfect Retirement, is available at thegreatcourses.com and at wondrium.com. Sensible Money was recently ranked 35 out of 500 in USA Today's best financial advisory firms and named a best place to work for financial advisors by Investment News earlier this year. And for the third year in a row, Sensible Money has been cited by Inc. 5000 as one of the country's fastest growing private companies. With Dana today is Oscar Vivas, a Florida-based CPA who joined us recently as a financial planner, bringing a wealth of knowledge and experience, particularly around taxes. He also holds the designations of Personal Financial Specialist and Certified Financial Planner. In addition to being a speaker at industry conferences around the country, Oscar has been a frequent contributor to several well-known financial news and information outlets. I'm Nancy Fellinger, another financial planner here, and I'm in Pawleys Island, South Carolina. Most of the team is based in Scottsdale, Arizona, and we also have team members in Massachusetts, Oregon, Indiana, and South Dakota. Using some of the same technology that we're using today, we work seamlessly with each other and with clients in 38 states across the country. You will see a question box on your GoToMeeting screen, and we encourage you to add any questions to it as we go. Dana and Oscar will have plenty of time to answer them as we go. I may respond to some of you directly or follow up with an email. And so with that, let's get started.
Hi, everybody, and thank you, Nancy, for the wonderful introduction. I want to start with our favorite thing in the world, disclosures. So, of course, we need to have disclosures and let you know that we're going to be talking about broad general concepts. Only someone that knows your situation can tell you how this applies to you. We may talk about case studies, we may talk about specific examples that we've encountered with clients, but none of those are guarantees. Of course, you know this, that those situations or examples would apply to your situation. So that being said, let me talk about what we are going to cover. We have the content broken into 3 phases. So basics, we're going to talk about just generally, how do the tax rates work? What does that look like? How do you withhold taxes? Like, what is the functionality of how you actually pay taxes during retirement? Then we're going to be talking about the opportunity years. There's a lot of moving parts that occur between about the ages of 55 and now, up to 73 to 75, depending on when your required minimum distributions start. So we'll be looking at all of the moving parts during those years. And then the last section, we're going to talk about strategies. So what are the things that you can do? Like, what are ways that you can structure things so that over your lifetime, you may possibly reduce your tax bill? Not this year, but we like to look at cumulative taxes over the 20 or 30 years that you may spend in retirement and figure out, are there strategies that can reduce that cumulative tax bill? So let's start with the basics. When we're talking about retirement, your cash flow, and I'm using that word on purpose, your cash flow comes from a lot of different sources. So while we're working, we think of income, and income comes through our paycheck. There's tax withholding that happens, and our income is often closely aligned with what shows up on our tax return. Unless you're a business owner, that's a whole nother story. But for a lot of us, your income is closely aligned for what shows up on your tax return. Well, in retirement, you have mutual funds, stocks, CDs, savings accounts. You might own those in a non-retirement account, and they have a particular type of tax treatment. You have a Roth IRA, maybe, where withdrawals are tax-free, assuming you followed a certain set of rules. You have IRAs and 401ks where everything will be taxable. You have Social Security, which is partially taxable. You might have rental income, pension. So there's a lot of different sources, and they're all coming together to form your retirement paycheck. And each one of these sources can have a different kind of tax treatment, which is what makes it so challenging to plan for taxes during retirement. Now, when we talk about taxable income, that may not reflect the actual cash flow that you see. So in retirement, there can be a big disconnect between the cash you're receiving and living on and what actually shows up on your tax return. Let's look at how the tax rates work. And now this part works the same while you're working or whether you're in retirement. We have here 2024 rates. We have single rates on the left-hand side, married on the right-hand side. And this chart reflects taxable income. So after your deduction, itemized or standard deductions, so after your applicable deductions, your income flows into this chart. And only the income that falls within these ranges is taxed at the applicable rate. So we call these your marginal rates. And sometimes there's this misconception that, oh my gosh, if I cross into the 32% tax rate, then all of my income is now taxed at 32%. But it doesn't work that way. It's like a waterfall schedule. The income that falls for a married couple in 0 to 23,200 is taxed at 10%. The income that falls in this range is taxed at 12, and so on. And so sometimes you'll hear terms like marginal rate versus effective rate. Effective rate is like a blended rate. You take your total tax divided by your taxable income, and that was your effective rate. And it's typically going to be lower than what your marginal rate is. If you use an assumed marginal rate for your retirement planning, that can be problematic. And we'll talk about that throughout this webinar, why you need to look at your specific sources of income and have a projection model that taxes them appropriately. Otherwise, your assumptions and your planning may be giving you an answer that is not going to be correct. Now, in addition to these ordinary income tax rates, you have qualified dividends and long-term capital gains rates. And these are taxed according to a different schedule. So you have something called the 0% capital gains rate that falls in this range. And there's many times where we've seen people when they first retire, and Oscar's going to talk about that in a little bit, their tax rate might be much lower. And we've had an opportunities to exit out of stock where we could keep somebody's income in this range and realize capital gains of 60 to 80,000 and have them pay no tax on realizing those gains. Doesn't happen all the time, but when those opportunities come about, it provides an excellent opportunity to take advantage of the tax code as it stands today. You have this next range where capital gains and long-term qualified dividends will be taxed at 15%. And if your income is in a high range, those same capital gains and qualified dividends will be taxed at 20%. Now, a common question we get is, what is a qualified dividend? So most regular dividends from U.S. corporations are qualified. If you own an S&P 500 index fund or a blue chip stock, the dividends you're going to receive are typically qualified. If you own master limited partnerships or real estate investment trusts or foreign companies, those dividends may not be qualified. All the dividends flow into your tax return and you'll see a total dividend line, and then there's a subset that says qualified dividends. And that subset of dividends that are qualified, that income gets this preferential tax rate. So when we put all of this together and you have your income coming from all of these different sources and these various tax rates that apply, you have to figure out how you're actually going to withhold and pay taxes in retirement. And here I'm going to turn it over to Oscar to talk a little bit more about that. Oscar?
All right, Dana, thank you. So, what's interesting is that when we are working, if you're a W-2 employee, your taxes are automatically withheld from your paycheck, and you never really have to think about how am I going to pay my taxes. But as you transition into retirement, that's really an important thing because there's no longer a corporation doing that on your behalf. And so, to Dana's point, there's different types of income items that are flowing through in retirement, and they're all taxed differently. However, what's interesting to note is that you can't have a withholding from all your various income sources. So But the ones that are highlighted in orange, so if you have pension or Social Security or distributions out of your retirement accounts, you can set up a withholding that goes straight directly to the IRS. But from some of the other sources, that's not really the case. And the reason why this is important is because, again, when you were working, you didn't have to worry about sending your tax withholdings because it was being done automatically. If you flip to the next page, what we want to make sure that doesn't happen to you is that you get caught in underpayment penalty land, which means that if you don't pay your taxes throughout the year, and I'm going to talk about this, you can potentially owe underpayment penalties, and we want to make sure that you avoid that. And so here's more or less at a high level how this works. If at the end of your tax year, if you owe less than $1,000 in tax, you, for the most part, you don't really have to worry about paying any underpayment penalties. However, the IRS has something that we call a safe harbor, which says if you do these things, for the most part, you don't have to worry about any underpayment penalties. And that depends on how much income you earn in the prior year. So going down the first column, if last year, if you earned less than $150,000 for your AGI, then you can either pay 100% of the tax shown in the prior year or 90% of the tax for the current year, whichever is less. Now, what's interesting about this is that we know what 100% of last year's tax is because we know what last year's tax is. We don't really know what 90% of this year's tax. So we have to do projections, and if we're choosing that route, we just want to make sure that we're being meticulous in our accounting and records so that we don't get hit with an underpayment penalty. Now, if you're over 150,000 from the previous year, instead of 100%, it's you either pay 110% of your tax or 90% of the current year. Again, that's whichever is less.
Yeah, and Oscar, I wanted to pause. I know you and I were talking as we were preparing for this webinar about some things we've seen. An example is, as you're transitioning into retirement, as you mentioned, you don't know what this year's taxes are going to be. And I have seen cases where the CPAs, the software they use, will automatically schedule out quarterly payments that someone's supposed to make, but those are always based on last year's numbers. And so I've seen cases where someone had stock options or, usually it's options or some big income event, and the CPA is saying, well, you need to make $30,000 or $50,000 a year of quarterly tax payments this year. And we're the ones going, wait a second, no, they've retired now. So this calendar year is going to look completely different, and we really don't need to lend the government that much money throughout the year. I assume you're seeing that, or you've seen those cases also.
Absolutely. Yeah,
Yeah.
so the extreme cases is someone wins the lottery, right? So they have to pay a huge tax bill, and that's an extreme case, but it does happen. And the following year, you don't want to have to pay 100% of the lottery year's tax, right? So yeah, so,
Yeah.
so you just have to make sure that you're staying on top of that.
Yep. Absolutely.
Now, I don't know how many here on the webinar today have played the famous game Monopoly, but if you recall, right, every time you go around the corner, you collect your $200, right? So the tax system is similar to that. The way that income taxes are paid, they're actually supposed to be paid throughout the year as you earn the money and as the year goes. And so again, when you're working and you're getting W-2, you're not really thinking about this, but when you're not working, it becomes something that you have to put a little bit of thought into. And the way for the most part it works is that for the most part, you have to pay an equal installment amount at each of these dates that are shown here on the screen. And so that by the end of the year, you would have paid your taxes evenly. Now, sometimes for whatever reason or another, we don't make the right amount of estimated quarterly payments or whatever it may be. Sometimes it might be an error. It might be that you were in a disaster area where things happen, you couldn't set it up. Or in other cases, you might have had something going on in the family, a death or an illness that prevented you from making payments. And so one trick that you may not be aware of is that most of you are going to have retirement accounts. And if you take a distribution out of that retirement account, and let's just say it happens at the end of the year, you can actually have 100% of that distribution from your retirement account withheld and go directly to the IRS. And what the IRS will say is, okay, they're going to assume that that distribution, that withholding was paid evenly throughout the year. So it'll help you to stay out of underpayment penalty land if that ever happens. Um,
Oscar, I'm
and the
sorry.
other thing,
Oh,
yeah,
yeah, I got actually as you're talking about this seems to be a hot topic because
yeah,
there are four questions, or actually more now, related to the underpayment penalties.
okay.
And I'll start with how stiff are the underpayment penalties?
And I'll be honest with you, they're not the stiffest penalties around. I mean, there's a cap, I think, of up to 25%. I mean, it is stiff, but in order for you to hit the cap number, it probably takes several months before you hit the maximum amount. Um,
Now,
so
I want to add to that, while they're not stiff because interest rates are higher now, we are seeing that those underpayment penalties are coming in larger. So there's an interest rate component to that underpayment penalty. And so with higher rates, they're larger than they were a few years ago.
Yeah, and there is another question kind of related to that, and the questioner says, "I don't get this. What has the previous year got to do with the current year? I've never had to pay taxes based on what I did last year, only what I earn this year."
yeah, and again, I think that's a function and a byproduct of the fact that, if you're working a traditional job, the company's handling that for you, so you don't really have to think about it. But once you're retired and you don't have a company payroll system doing that on your behalf, in essence, the IRS has these rules that they say if you pay at least what we're showing here on the slide, if you pay at least that, then you don't have to worry about underpayment penalties. And so that's the numbers there for your own personal reference.
Yeah,
Okay.
and just to clarify that, it's not, so if you paid in 100% of last year, you avoided the underpayment penalty. And if you don't end up owing that amount when you file, you will get a refund. So, as Oscar's describing safe harbor, just like you said, they're just saying this is one way to be exempt from any underpayment penalty.
Okay. And the last question, Oscar, on this would be, I think you already touched on it, but how can you avoid underpayment penalties if you do a large Roth conversion late in the year and only pay the taxes due at the time the conversion is made, and that would be through withholding potentially some IRA or just paying it at the end of the year?
Well, and so we're going to talk about this in a little bit, because the reality is that hopefully, as you're going through the year, you or a CPA or your financial advisor is helping you look at how much needs to be paid to the IRS, and helping calculate what the amount on Roth conversions, how that's going to impact the payments that you make. But I will say this, and I had a personal experience with this. If you get into an underpayment penalty scenario, you can, in essence, appeal to the IRS. You file a Form 2210, and if you had some unfortunate event happen in your personal life, and I'll give you a personal example. When my son was born in 2021, it was kind of a chaotic moment for me, for my son and my wife, a lot of hospitalizations and all that. And I actually ended up missing one of my Q2 payment for the second quarter. And when I filed my tax return, I just pretty much let the IRS know, like, hey, here's what happened. Here's why I didn't make that Q2 payment. And as long as it's something relatively reasonable, then, for the most part, you would be okay. So just know that that's something that's in the back of your pocket if it ever happens.
Yeah, and I want to go back to the Roth conversion question too, because like as Oscar said, you're working, with a planner or, you're doing the planning yourself. When you talk about pay as you go, so there is a form where you can allocate the income by quarter. And so if your income all occurred in the fourth quarter, then you could pay that portion of the tax on January 15th for that Q4 payment. Now, we have seen cases where that happened, but the person preparing the tax didn't know how to do that. It's, I don't know if you know the name of the form, Oscar, I can't think of it.
Yeah. Well, it's the annual income installment method, and it's actually filed with that same Form 2210.
Okay. Yeah, I've seen cases where it was missed, and so someone owed an underpayment penalty that they shouldn't have actually paid if someone took the time to fill out that form and allocate the income by quarter. Anything
Okay.
else on that,
Yeah,
Nancy?
there is one more that's I think especially relevant. Can Oscar re-explain end of year retirement withdrawal holding?
Yeah, let me just give you a very simple example because I think that'll bring it to life. Suppose that your tax for 2024 is going to come out to be 20,000 for the year. Let's just use that as round numbers. In most cases, you're paying $5,000 at each of these different quarterly dates, right? 5,000 April and June, September, and then again in January. So that at the end throughout the year, you pay 20,000 and it's all good. Suppose, however, that you didn't do that and it's December 25th as you're opening Christmas presents and you realize, holy moly, I haven't sent any payments to the IRS. What can I do? Well, so if you happen to have an IRA, a retirement account, you can take a distribution from that. And let's just say you're going to take a $20,000 distribution or whatever the number is and have it sent to the IRS totally. In that particular case, that move of using your retirement account and sending the check directly to the IRS will count as if you would have made payments all throughout the year, and therefore it would have helped you to avoid any kind of underpayment penalties. So it's just a little trick that that allows us to have a little flexibility in helping you avoid that if that happens to you.
Yeah, and just so, for those who've never done it before, when Oscar says, like, have the check sent to the IRS, you aren't sending the check, the custodian is. So, it's a box you check when you're doing the distribution. Yes, I want tax withholding 100%, and it's getting sent from whoever your custodian is. They are paying it to the IRS for you. And at the end of the year, you will get a 1099-R tax form, and it will show that that withholding happened. So that tax form, gets turned in or collected with all the rest of your tax documents. So you don't take the check and send it in. Your custodian sends it right to the IRS for you.
Awesome. These are good questions. Keep coming. Dana, back to you.
Yeah. So moving out of the basics that really aren't always so basic and onto the opportunity years. This is that time frame that we loosely describe as between about 55 and 75, where there can be a lot of opportunities to squeeze more, to lower your lifetime tax bill. And that's what we want to talk about here. Now, this page you're looking at is available as a handout. So somewhere in your GoToMeeting control box, there is a way you can download handouts. You should see this page and also chapter 4 of my book, Control Your Retirement Destiny, which is the chapter on taxes. So those are both available to anyone attending as downloads. But this is loosely describing all of the things that happen. So at 50 and 55 for most people, if you were to leave your employer during the year you turn 55 and leave your funds within the plan, there is a special provision that would allow you to take withdrawals exempt from the early withdrawal penalty tax. And sometimes with planning, there's some reasons to do that. That provision can apply as early as age 50 for certain public safety workers. At 59 and a half, you have the first time that you can withdraw from IRAs or other retirement type of accounts, 403Bs, SEPs, Simples, and so on, without being subject to that penalty tax. 60, the earliest age widows or widowers can start Social Security. 62, the earliest that we can each claim our own retirement Social Security. 63, now there's nothing really special about 63. It's just we'll talk about in a minute how the Medicare premiums work, and they are means tested, and so they will look back at your tax return 2 years prior, always on a rolling basis, but this is the first year that happens. So your tax years, the year you turn 63 is what's going to determine your Medicare premiums when you turn 65. 65 is where Medicare starts for most people. It might be an exception if you're still working for an employer with over 20 employees. 66 to 67, full Social Security age. 70, that's where you get your maximum Social Security. And then now required minimum distributions begin at 73, depending on your date of birth. If you're born 1960 or later, they begin at 75. Wow, like that's a lot of stuff happening in this, what we might call 20-year time frame. And so there's, all kinds of tax opportunities where you might be able to take IRA distributions at a lower rate. You might be able to just take an IRA withdrawal. You might be able to realize capital gains at a lower rate. You might be able to qualify for something called the healthcare tax credit. So if you retire pre-65 and you can keep your income lower, there's a tax credit that can help you pay for healthcare up until you turn 65. So as we dig into some of those, Oscar's going to talk a little bit more about the details. Oscar?
So I often get the question, like, how do I win at the tax game? And the way I say it is, okay, the first thing we have to do is we have to try to lay out your tax picture, your long-term tax picture, as best as we can. Obviously, we won't have it totally to the penny 30 years from now, but we just want to see an overall picture of what things look like. And it is very common that when we work with retirees, their long-term tax picture looks something like what we're showing on the screen. That when they're working, they're up in the higher income tax brackets. And that's obviously going to vary depending on your job and your income and all that. But as a general rule, when you're working, you're making more money than when you're not working. I know that sounds kind of obvious, but and then on the other extreme, and what happens is, okay, yeah, what happens is you stop working and your income drops kind of off a cliff. And then at some point you start taking Social Security, so it might creep up a little bit in those kind of later years. And then at some point you have to start taking money out of your 401ks or your IRAs, right? And so now your income and your tax brackets go up again. And so what happens is this scenario creates the opportunity to lower your lifetime tax bill. Now, how do we do that? Because oftentimes when we're thinking about saving money on taxes, we're thinking about how do I save the most money on taxes this year? But in reality, it's how do we save the most money on taxes over the course of your lifetime? And so what do we do? Well, if you happen to be working, at that particular point in time, we want to try to get as many deductions as we can, saving as much as we can into our 401ks as an example. Once we retire and our tax bracket drops, what we want to do is we say, hey, in about 8 to 10 years, I'm going to have to start taking distributions from my retirement accounts. And when that happens, according to just this illustration, I might be in the 33 or 35% bracket at that particular point in time. So what we want to do is say, hey, if I have the opportunity to pay it at 10 or 12 or 22% in this kind of window, you will end up saving taxes over your lifetime two ways. Number one, you end up paying less taxes on those same dollars, and by doing that, you're also reducing your future tax bill. And so what we're trying to ultimately do is find that equilibrium where we're paying the least taxes kind of over our projected lifetime. Now, I want to talk a little bit about some of these opportunities that Dana mentioned during our retirement years. One of those opportunities is if you happen to retire in advance of Medicare, so earlier than age 65. So let's just take 62 as an example. Um, and you say, okay, I need health insurance, but I'm not eligible for Medicare. What do I do? In many cases, people end up going to the healthcare exchange, the Affordable Care Act, to buy a policy. And the rule, and like Dana mentioned earlier, the government, depending on your income, gives you premium assistance towards your health insurance premium, depending on your income. Now, what we're illustrating here is the old rule. And it's important because the old rule will also become the rule again in 2026. So, we just want to talk about it. But the way it used to be is that let's just take a household family size of two, right? The rule was if you earn $1 over 400, you'll get assistance as long as you stay within below 400% of your federal poverty level. And that's the chart that we're showing you here. And it varies depending on your household size, how many kids, are in your household, how many people and all that. But let's just say a family of two, right? It used to be that if you earned $1 over that amount that we're pointing at, you would lose all the assistance to your premium tax credit, and you would have to pay it back. And we're going to talk about that in a minute. That was the old rule. So the old rule was you can get a tax credit towards your health insurance as long as you stay within these income levels. Now, that has changed for the years 2021 through 2025 with some of the things that President Biden has implemented. So, what are the new rules? The new rules say this. You, Depending on where your income falls relative to the federal poverty line, the government says you are responsible for paying that particular percentage of your health insurance premium, and we'll pick up the rest. And so they base the assistance that they give you for your health insurance on these income lines. But the one thing that you want to note is that there's no longer a cliff after the 400% of the federal poverty line. And we're going to give different examples so that we can illustrate it. But in essence, over these next 2024 and 2025, and unless they extend it again, a lot more people can receive help on their health insurance premium through the healthcare.gov. So this is an example. I'm based out of Tampa, Florida. And so at a high level, if your income, and we're going to talk about income in a minute, was $50,000 for your household. And this is for Hillsborough County and Tampa. It's going to vary depending on where you live and the ages of the applicants. But in this case, we have a 60-year-old couple. And if they earn $50,000, the subsidy that they would receive towards their health insurance is $21,636 for the whole year. And you can see that as they make more money and earn more income, the subsidy goes down. But it's not as bad as it used to be. Whereas if you were a household of two and you made over 81,000, you pretty much lost all the help. In this today's rules, you still get help, but they just go down until eventually you make too much money and you don't get any more help. Now, again, this is a very specific thing that applies to people that are not on Medicare. But ultimately, if you need health insurance and you go get health insurance from the exchange, they're going to ask you a series of questions, including what's your estimated income. And you know, uh, I always say do your best at estimating the income, because what happens is they're going to base your assistance and your subsidy based on what you put in that form. But then when you file your tax return, there's this form that you have to fill out, Form 8962, which will reconcile what you said in the application and what in the assistance you received to the actual income that you earned for the whole year. And then if you understated your income, then you might have to pay back some of the subsidy that you received, and vice versa. If you overstated your income, then they'll give you more money, but they ultimately reconcile this on the tax return. And Dane, I think you had a case study on this slide.
I did. This is actually a screenshot from a real tax return. And, it's a client, they'll be 65, 64 this year in 2024. This was from a prior year, $3 million portfolio. And they take 12,500 a month out, which is 150,000 a year. That's the cash flow they have. So we talked about cash flow, but their modified adjusted gross income is 46,824. And a lot of that's accomplished because when the portfolio was structured as bonds mature in their brokerage account, when a bond matures, that's not taxable income. The principal amount matures and that doesn't cause a tax event. There's interest income along the way, depending on the type of bond. And so we're not taking any IRA withdrawals, and everything that's taxable is included here. But there's a big discrepancy, obviously $100,000 between the cash flow they're receiving and their modified adjusted gross income. And so they were able to qualify for 17,709 tax credit. Now that's what was allowed the year before. This was the advance of the tax credit was 18,588. And so this difference would just be recaptured, essentially what they owe when they file their tax return, to pay back any credit that they were advanced that they weren't actually eligible for. Now it could have gone the other way too, right? They could have gotten a lesser credit, their income came in lower, and so there could be an additional refund due to that. As Oscar said, this is where the reconciliation happens.
And
Now,
Dana, before you move on, oh yeah, I was gonna say this is so important because even though the current rules are a little bit more forgiving, they're scheduled to end at the end of next year. And I'll give you a quick thing that I actually saw, and this is why it's so important to consider when you're doing your financial plan, your retirement plan, to think of all the various levers that are impacted by every little move that you make. But I'll give you an example. Under the olden rules, that where I mentioned if you went $1 over the limit, you lost the whole subsidy. Well, I saw an advisor incur some capital gains. They sold some stocks at a gain, and it tipped them over the edge by a few bucks, and they had to pay back $16,000. And trust me, they were not very happy about that. So just be mindful that these things are out there, and then seek help if you need to.
yeah, and it's an excellent point because they all interact with each other, right? It's like a giant jigsaw puzzle where if you move this, there's this trickle down effect, and it might impact this and this and this.
Yep.
Oscar, I think you were also going to talk about all of the forms of
Well,
MAGI.
so throughout this conversation, we've talked about income, income, income. Well, the version of income that's often used is what the IRS calls modified adjusted gross income. Now, you would think that there is just one of such things, but the reality is that depending on the context, it changes. And so just a minute ago, we were talking about the healthcare tax credit or the premium tax assistance, right? And so the way they calculate income is not just your adjusted gross income. They also add back uh, part of the Social Security as well as any tax exempt interest. So if you happen to have municipal bonds, you may not be paying federal taxes on that, but for purposes of calculating your modified adjusted gross income for the healthcare tax credit, they add that back into the formula. So, and then what's interesting though is that if you look at, say, the last bullet point, which is dealing with Medicare, the way they calculate modified adjusted gross income is your AGI plus your tax exempt interest, right? So, and then in the first two bullet points, the point that we want to make here is that there's different calculations of modified adjusted gross income. that you just have to be aware of as you're in this retirement phase?
Yeah, and we will sometimes, ideally, if somebody's working with us, they will email us and say, "Hey, what is my MAGI for, specifically what they're looking at?" Like if they're looking at Medicare premiums versus healthcare tax credit, usually we know what they're looking at, and we can say, "Okay, here's what the number is that you would use on this form." The other thing is we were talking about everything being interconnected. If you claim Social Security early, that's now going to impact your ability to qualify for this healthcare tax credit. So they definitely all tie together. We've talked a little bit about what we call IRMA premiums. Income related monthly adjustment amount is what IRMA, IRMAA, stands for. And these are means tested, meaning the higher your income, the more you pay. So this applies once you're on Medicare and claiming Part D, Part B and D. And so here we see that if you're single and your income is less than 103,000, I think this should be zero. Oh no, sorry. I'm all of a sudden I was thinking they're off a line, but they're not. So if you're single and you're paying less than 103,000, you are going to pay zero for your Part D premiums, and you're just going to pay the baseline 175 for Part B. But as your modified adjusted gross income, the specific formula that applies to this premium, goes up, you're going to start paying more. So after you cross this 103 threshold, and these thresholds are indexed to inflation, but after you cross these, then for a married couple, you'll start paying $244 for Part B and $13 for Part D, and so on. And so you can see these thresholds go up. And there's interesting. Christine Benz from Morningstar just had an X post about this today, where she was saying, she sees a lot of focus on this, and if you're making, over $500,000 a year, is this such a big amount? And I agree. It's not going to make or break your retirement plan at that point. At the same time, if you're in these income thresholds, and we can be aware that you may be close to going over one of these limits, and say, let's take a little bit less out of your IRA this year, or let's not do quite as much of a Roth conversion, or let's not realize those capital gains until January. Now, each one of those decisions requires pros and cons. None of them are, clear, absolutely do this or don't do that type of decisions. But you can be thoughtful about it. And so sometimes you can avoid crossing over into one of those next IRMA thresholds. I'll give you an example. This is a client Oscar and I just met with about 2 weeks ago, and they had retired, but most of their workplace plan had rolled into an IRA. But sometimes what happens is the next year, the employer still has a profit sharing contribution that they have to make for all the employees that worked there the year prior. So they ended up with this extra $6,500 suddenly in their old workplace plan. And they asked us, should I just cash this in or roll it over? You think it's only $6,500, like why go to all the hassle to do the rollover? Except that when we looked at where their income thresholds were, that $6,500 might be the thing that pushes them into this next threshold. So in that case, we said, you know what, let's not worry about that. Let's just roll it over. Next year in 2025, you don't have this deferred comp payout that you're receiving now, so your income will be less. And so that would be a better opportunity to have any extra taxable income.
One more thing on this particular slide. Sometimes, she mentioned it earlier when she was looking at the chart of the various things that happen at various ages. But let's just suppose that you just retired and you're 65. And you get the letter, and you get the letter, and it says, "Hey, your Part B premiums are going to be $349 based on what your income was from 2 years ago." And you might say, "Wait a minute, what? My income just dropped, and now I have to pay a higher IRMA amount to Medicare?" Well, so there is this form called Form SSA 44, and in essence is if you've got it's 7 to 8 different life-changing events that they call, so like marriage, divorce, death, or work stoppage or work reduction, for example. If any of these apply and your income's going to change fairly significantly, or it doesn't have to be overly significant, but you can submit that and in essence petition them to make your premiums lower based on that kind of whatever event applied to you. So I just keep that in the back of your mind as you transition to Medicare.
Yeah, and that's an excellent point because a common question we'll get is, well, can I get an exception because I realized capital gains or sold a business or did a Roth conversion? No, you cannot. However, let's say we realized capital gains and that coincided with work stoppage. Well, then there is a case to file that form and say my income will be a lot less, and so this higher premium should not apply. There's also required minimum distributions that we've talked about. And this is a simple example that says for every $100,000 that you have in a tax deferred qualified account, that would be a 403B, 401k, IRA, here's what the IRS says you have to take out each year. So it's a divisor based on your age. Each year you get older, the divisor gets smaller, so you have to take out a higher portion of your remaining balance. That's recalculated every year. So every year you look at your December 31st balance from the prior year, and that tells you the amount that you have to take out in the current year. And so that grows substantially. Of course, by 94, you're taking out over 10% of your remaining balance a year. But this is what can cause some delayed tax consequences, or sometimes, we'll talk about how could your tax rate actually be higher later in life. Well, it can be. And Wade Pfau had a LinkedIn post on this. I believe it was just this week. It might have been actually the tail of last week. And he posted this graph that I am using, attributing it to him. And here he's talking about the formula between how Social Security is taxed and how your other income comes into play. So across the horizontal axis, you see ordinary income, not including taxable Social Security. And across the top, you see an effective marginal tax rate. Now, that is a completely different thing than the effective rate or than the marginal rate. So we're throwing in a whole new term here, calling it your effective marginal rate. And this yellow line is your ordinary income tax rate. So that would be what we were previously calling your marginal rate. And what he's showing is that for every dollar of extra income that flows in many cases, it's making more of your Social Security taxable. And for a single person, this can create this window or these pockets where you're paying, almost 50% a tax rate on the extra dollars of income in this range. And so again, where we see this apply in real life, Oscar and I were on a joint meeting with a client that we have worked with, or I've worked with since 2000, I believe, 6. They are 88 now. And in their projection model, we're always planning for, what happens if one spouse passes before the other. And so in their case, what happens is they both get Social Security, and the surviving spouse will only keep the higher Social Security amount. So they will lose about $20,000 a year of Social Security when the first spouse passes. In addition, there's a VA pension. So if the spouse with the VA pension passes first, they will lose that $10,000 of income. And on top of that, the required distributions stay the same because you have all of the combined amounts between both IRAs, and the surviving spouse still has to take them according to that formula. And so they're now filing at a single tax rate. And so when all of that happens, even though they would lose $30,000 of cash flow from Social Security and the VA pension, their tax bill would double, and it would cost them $10,000 a year more in taxes. So that's a $40,000 delta difference in total cash flow for the year, simply based on the way that the tax code stands today. So that's how we see these kinds of it's called sometimes the tax torpedo. That's how we see it impact people in real life. Oscar, anything to add to that?
Yeah, the other thing that I would just add is, yeah, so and if you go back to some of the earlier slides, I won't say go there now. You'll see that the tax rate for a single person, you move up the tax brackets a lot quicker. And so it's very common that when one of the spouses dies, that your tax rate tends to go up. And everything is case by case depending on what types of assets and income you have. But in many cases, when one spouse dies, you might find yourself in a higher tax bracket.
Yep. And that brings up the question is, well, what if I'm already single? And we go, well, those higher rates already apply to you and they become part of that planning process. I have seen cases where Roth conversions did not make as much sense for a single person simply because of the way that the tax rates play out. Now, that's not always the case, but know that if you're single, the same strategies that apply for a couple may not apply or work as well for you. When you're planning for this phase, this is an example of what it can look like. So here we have a sample couple and you see their ages at year end, and this is how their tax rates will play out. So when we look at this schedule, it's telling us how much room is remaining in each bracket. So their income for the year fills up the 10% bracket. It fills up the 12% bracket, and we have $63,000 remaining in the 22% tax rate. Now, we might say, great, if we were looking at this projection all the way out into the future, and we could see that by the time they're both in their mid to late 70s, this tax rate may be much higher. If we could see that, we might say, great, let's withdraw $63,000 this year at 22%. Or do a Roth conversion. And that will allow us to pay at this lower rate because we're going to expect you're going to be in a higher rate later. Maybe you'll be at the 28% rate a few years from now. But there's a second consideration. Down here, we have the Medicare premium. And so if we did the full $63,000 of Roth conversion, it would push them over the first IRMA threshold. So we might say, well, what if we only do $30,000 of Roth conversion? Now, we've done this analysis many, many times, and in many cases, despite crossing a IRMA threshold, it does still make sense to do the Roth conversions, but not in all cases. And so you can run that projection model out and say, okay, where is the trade-off or the break-even? Sometimes we've done Roth conversion analysis, and I've said, well, if you live long enough, right, then this will work in your favor, but the break-even point isn't for 22 years or 25 years. And somebody might look at that and say, that's a long time. Other times we've done an analysis and the break-even point might be 7 or 8 years down the road where we say, wow, this is something that can really add value to your financial situation. You can also see in here the capital gains and qualified dividend tax rates. So the 0% rate is full, and there's $439,000 of room in the 15% cap gains rate before it would bump into 20. So this can be applicable if you're exiting out of a concentrated stock position or selling a piece of real estate that has a lot of embedded capital gains, just to see, okay, if I can do this in a year where most of it's taxed at 15 instead of 20, again, that's a little bit of tax savings, an extra 5%. We'll take that anywhere we can get it.
Dana and Oscar, let me throw this out to you. It's understanding that each case is different. How much in general might a typical retiree expect to save in taxes through good planning?
So we might have different answers on that. I have seen cases where it is substantial, like up to $500,000 or more. Yep. And I have seen what I would call your question more the average retiree, right? where it could result in the equivalent of $50,000 to $100,000 of, in today's dollars, tax savings. So that's about the range where I see it. For me, $50,000 to $100,000 just from planning is still a meaningful amount when it's as if you retired with an extra $50,000 or $100,000 in the bank. I think that makes a difference. Oscar, what do you see?
No, I've seen similar numbers, and even sometimes, higher. It really depends on the more dramatic the ups and downs of the various tax brackets over your lifetime are, the more you're going to end up saving by doing planning. So if you're like, I'll give you an example. If you're like in the 37% bracket and then you're retired, you're like in the 12% bracket, and then at some point you're going to be in the 37% bracket again or something, right? That's dramatic from the top to the bottom and all that. You're gonna be able to save a good amount of money. And the other thing that I'll say is there's actually two components to that. Number one is how much money will I save over my lifetime? That's what we just mentioned. But then because I'm saving that much money over my lifetime, my wealth, because I'm not paying that much more money to the IRS, my wealth is now going to be able to compound. So the actual effect on your total wealth is going to be greater than just the tax savings. So just keep that in mind.
Yep,
Here's
excellent point.
another one
Nancy?
I'm sorry, here's another one for both of you. How does the government set next year's tax brackets for income taxes, dividends, long-term capital gains, and IRMA tax brackets? Is it based on inflation or some other methodology? Are there any rules of thumb to forecast my taxes manually in Excel?
Oscar, you want to take that one or you want me to?
Well, it's based on inflation, but it's interesting because just like there's various modified income amounts that are used for different things, inflation, what we tend to hear in the news is not always the same inflation that gets used for these various items. So just be aware of that. Now, I think it's fairly hard. I mean, I guess if I had to put a number on, I mean, you can look at long-term inflation somewhere in the 3 to 4% range and say that. But I will say that if you're projecting your own taxes, remember that our current tax system is scheduled to expire at the end of next year, and we'll go back to the old tax brackets like they used to be before 2017 or in 2017. So just be mindful that the brackets are going to jump and all that. So it's at this particular point in time, it's a little hard to do, but you just have to kind of know what the old numbers were and kind of project them forward. It's an exercise that that'll take you quite a bit of time if you're just doing it on your own.
Yeah, it will. As Oscar was saying, so here you'll see 22%, and then in parentheses it says 25% starting in 2026. Because as it stands now, income that falls in the 22% threshold will then be taxed at 25% starting in 2026. However, also built into these thresholds behind the scenes, we are using a 2% indexing on the various components of the tax bracket. And to complicate it even more, they're not only like tied to the consumer price index, but there's certain thresholds, kind of like your IRA limits go from, you can contribute 7,000 and all of a sudden it goes to 7,500. So each component of the tax code will have a threshold amount that's rounded to, a nearest 100 or nearest $500 amount. And so we actually built all of that into the model that we use. And then every year you have to update it based on reality. So for several years, 2% was too low. And that was fine because it was actually taxing more of the income at a higher rate. And so we would rather be more conservative in that. If inflation averages 3%, then great. What that's going to mean in the model is that less of the income is going to be taxed at these higher rates. So we try to err on the side of being more conservative in those projections when we do that. There are some online tools. There's a website called Dinkytown, and that's actually a town, I believe, in Minnesota that has a tax projection tool. I don't know if it has future years, but it does do an excellent job for your current year. And there's also tools that advisors use, like Holistiplan. You can subscribe to that. It's about $1,000 a year. To me, relative to the tax savings that you could have, that's not that much. And that would allow you to do still not a full multi-year projection, but you could do several years at once. And then there's all kinds of online tools. There's one called newretirement.com where you could put in your full retirement projections. And again, it's not going to do a tax projection, but it is going to accurately calculate the taxes for you. Moving on, it's amazing how we run over, but we're going to talk about strategies, and of course we're going to leave time for Q&A at the end. And so as we're moving into the last component of the webinar, when we think of strategies, there's some things we've talked about, like Roth conversions, like taking IRA withdrawals out during the years where you're in a low tax bracket. There's things called qualified charitable distributions, and there's an overview of the different buckets that those fall in. And Oscar, you want to talk a little bit about these?
Yeah, so the reality is there's a multiple components that go into having a good tax strategy. One of those is how do we actually manage our investments, and we're going to get into this a little deeper here in a second. But the types of investments that you're investing in, that affects your tax situation quite a bit. The mutual funds or whatever investments you choose, and not only that, where you put those investments, right? Because you can have those investments in a 401k account, or you can have the same investments in a taxable brokerage account, and that's going to provide a different tax situation depending on what investments you have and where you put those investments. And then obviously we're talking about gains and losses. How do we manage that throughout the lifetime of your portfolio? That's very critical because, again, like we've talked about throughout the presentation, one choice impacts so many different things that you just want to be mindful. Now, so the investments that you have, and we're going to get into that more shortly, that's kind of one thing. But also, how do you handle your cash flows? If you're working, are you maximizing your 401k contributions, right? Looking for ways to squeeze more out of your retirement plan. If you're retired, right? Oftentimes people retire with multiple buckets of money, right? We might have an IRA or 401k. We might have Roth IRAs, and we might also have a brokerage account, right? How you take money and the combination that you use to take money out of those various accounts will impact the longevity of your portfolio and your tax situation quite a bit. And as a matter of fact, there's research out there that shows that doing that right, number one, can save you a good amount of money in taxes. And because of that, you can, in essence, extend the longevity of your portfolio by an extra few years just by being tax smart in the way that you withdraw funds from your various accounts. Now, I think it's important. I think if you take anything away today, one of the things that you have to do if you want to do this right is make sure that you have a projection, at least a long-term projection, because everybody's situation, and even though there are generalities, there are very particular instances in everybody's situation that changes things based on what's happening in your particular life. So if you haven't done it, try to project as much as you can based on your own situation so that you can get at least a sense of where my tax situation is headed. So now we've talked about how we manage the investments, where do we draw the money from, or what accounts we contribute to. And then there's a lot of other things. We've talked about Roth conversions. We've talked about healthcare credits, Medicare Part B. And, one thing that we haven't touched on too much today is charitable, right? Many of our clients have some sort of regular charitable activities that they're doing. Are we doing that in the most tax efficient way? We've talked a little bit about qualified charitable distributions, but in essence, what that means is once you reach 70 and a half, you can start using money out of your IRA and send it directly to charity. And the benefit of doing that is that it lowers your income in that particular year. So that can be a very good strategy. If you're already giving to charity, we might want to look into doing that when the time comes. For others of you, you've been invested in the stock market over the past 15 years, and you have a lot of gains in your stock portfolio. And if that's the case, and say you're giving money to charity, what I sometimes see is people are just giving cash because it's easy. Well, we might decide, hey, why don't we, instead of giving cash, give the highly appreciated stock, for example, to the charity instead? And it does a few things. Number one, it helps you avoid having to pay any capital gains if you were to sell it. So you're being a little bit more tax efficient there, um, and you're still meeting your charitable goals there. And the other thing, every now and again, depending on your particular situation, you might have random years that where your income is way high. It's either because you're working and you're earning a lot of money, or it could be because you're exercising stock options or you have deferred compensation plans that are coming into play in a particular year. And what happens is you'll see your income shoot up. And if you're already giving to charity, you might decide, hey, I give already whatever the number is to charity, 10, 15, 20K. Why don't I take 3 or 5 years worth of charitable contributions and do that in one year? You could either do that in one year directly to the charity, or you could use a donor advised fund where you don't have to give the money to charity right away, but still get the tax deduction in the current year. So if you happen to have one of these unusually large income years, you might say, hey, I'm already giving to charity. I'm just going to do 2, 3, 4, 5 years worth of charitable contributions in one year to try to lower my tax bracket. And then the reality is, whatever else comes up, right? Life is very dynamic, right? We have homes. Some of you guys have rental properties, businesses, and there's a lot of different complexities that come up when you start selling those, right? And so these things are that's part of what we have to consider um, as we're doing a tax plan.
Yeah, and I'm glad you brought that up. I'll give you an example. A lot of the clients we work with are coming out of corporate America, but we have some clients who are self-employed. I had one who was starting a new construction business, and the first year had a large net operating loss, which that presents an opportunity to convert an IRA to a Roth IRA and pay no tax. So if that kind of coordination is going on between the tax planning and the financial plan, there can be some big opportunities for substantial tax savings. Looking at some of these more specifically, because we're past the hour, I'm going to go through these pretty quickly, but we talk sometimes about something called a tax loss harvest or tax loss harvesting. And this is an example from Yahoo of using a Vanguard index fund and a Schwab index fund. And you can see that they track very closely. So one's the green line, one's the blue line. And there could have been an opportunity if you bought the fund here or here to do tax loss harvesting at one of these low points where you would exchange one fund for the other. You would capture the loss to be used on your tax return, but as the fund recovered, you wouldn't have actually realized an investment loss. Now, Oscar and I were having a conversation before this just about the IRS rule that you're supposed to exchange between investments that aren't substantially equal. And so would these two funds be considered substantially equal? And a case like that hasn't made it through the tax courts that we're aware of. Is that right, Oscar?
Yeah, I'm not aware of any particular tax court. It's a little bit of an untested principle in the sense that we don't totally know exactly what the IRS means by substantially equal investments. So, we kind of have to make some judgment calls there in the meantime. And if there's ever any guidance that comes out that's a little bit more specific, then we'll be certain to make the adjustments.
Yep. Now, where this shows up on your actual tax return are a few places. So this is a Schedule D, and first we see capital gain distributions. So that is from mutual funds. And sometimes, as Oscar was saying, you can own a fund that is not very tax efficient. I had a case last year. So a client transferred in a very large trust portfolio. It was about 5 million. And we go through, and if we can, we restructure the investments. But if someone's in a high tax bracket, we can't sell some of the investments they own because that would generate a very large tax event, not what we want to do. So there was one particular fund that had over $100,000 of embedded capital gains. We didn't sell it. Well, come year end 2023, all of a sudden there was this $100,000 gain distribution. So that fund distributed all of its gains that year, and that became a taxable event through no action of our own. Now, interestingly enough, that allowed us to then sell the fund immediately and realize a loss, which is kind of a strange situation, but it allowed us to at least offset some of those gains with a loss. But if you own mutual funds that have a lot of turnover, you will see these gain distributions flow through. And I mean, if you own them in a non-IRA account, and you have no control over that. So placing the investments in the accounts according to their tax impact makes a difference. Here is where the tax, go ahead, Oscar.
I was just going to say on that particular point, you just have to be very careful of what you own because I've seen clients that have had funds that pay 10% plus annually in capital gain distributions. Now, what's interesting is you're not selling the security, you're not selling the mutual fund, but yet you're getting this huge kind of tax bill that flows through on this tax return right there. And so, you just want to be careful that hopefully that what you own is as tax efficient as possible.
Absolutely. And here you'll see this is where if you had realized a tax loss, this is where it flows through, and then the two net each other out. If you don't have any other gains to offset this, what happens is $3,000 of it can be used against ordinary income, and the rest of the tax loss will carry forward to the next year. So it's not lost, it carries forward, and you would have, let's say, $6,346 available on the next tax year to offset any gains. Now, the last thing in this section we want to talk about is asset location versus asset allocation. So here you're seeing asset allocation. And this is a very simple example of someone that has $1 million and that is spread across 3 accounts. A brokerage account. For brokerage accounts, you get a 1099 each year where you claim the interest, dividends, and capital gains. An IRA account, and a Roth IRA. And each account is allocated the same. Now, we just use 3 asset classes: bonds, large cap, small cap. In reality, there would probably be many more asset classes, and some are more tax efficient than others. For example, a large cap index fund is generally going to generate qualified dividends. And so I would want to own that in my brokerage account. Whereas a small cap fund, if it were actively managed, is going to have a lot of those gains distributions that we talked about. So I might want to own that in my IRA or my Roth. If I own a real estate investment trust, it's going to have a lot more taxable interest income. So I might want to own that in my IRA, not in my brokerage account. And generally, when we are doing these projections, we see that most of the time, the Roth assets aren't going to be tapped for a long time. Maybe, much later in life, or maybe they're an asset that is intended to be passed along to the next generation. And so we really want the things with the highest potential for growth inside the Roth. And so if you were doing asset location, it might look like this. At a household basis, the account is the same. It's a 60-40 split, right? We have 60% in stocks, large and small cap or index funds, 40% in fixed income. But now all of the large cap, or a lot of the large cap, note this is small cap, is in the non-IRA. We have large cap, we have a little bit of bonds. The majority of the fixed income or bonds are in the IRA along with small cap or large cap. And I'm getting my colors all mixed up. And then we have all of the small cap the asset class with the most growth potential that's in the Roth. Now, this is not a recommendation. This is just a sample. So one of the things to consider is this sample doesn't take into account specific cash flows needed. So if I were just looking at this allocation, I would say, oh, this person must be taking most of the cash flows they need from the IRA. And that's why we've stacked the fixed income up inside the IRA. However, if I had someone who was taking most of their current cash flows out of the non-IRA account, I might have more fixed income stacked in here. And so there's some industry research and articles on this that show, I could choose to allocate across the household or locate assets in a perfectly tax efficient way, but cash flows should supersede that. So first, I want to look at where do the cash flows need to come from to support the lifestyle needs in retirement. And once I've outlined that, then I can apply a location framework to keep the portfolio as tax efficient as possible. The last thing we're going to talk about before Q&A are just some mistakes to avoid. So these are things that we've seen, and we do a tax review for most of our full service clients every year. We've seen people make non-deductible contributions, but they don't track those on a Form 8606. So now when they take an IRA withdrawal, they're paying taxes on the full amount of the distribution when they shouldn't have to. We've seen 1099-Rs report the gross amount of the distribution. Unfortunately, this is standard practice. So if you made a qualified charitable contribution out of your IRA, it is up to you to say, hey, I took $50,000 out of my IRA, but $20,000 of that went right to charity. The 1099 will not support that. We've seen rollovers that were incorrectly reported, or 1099-R income. We've seen people who it was their very first year of retirement and they just didn't even know to look out for the 1099-R, so they completely missed the $60,000 they took out of their IRA, or they missed the fact that their pension was now reporting taxable income. Or people who move, they don't update their address, and so the tax forms don't reach them. And there's also pro rata taxation that applies to Roth conversions. And so if you had non-deductible contributions, then every dollar that you converted to a Roth, well, a portion of that should not be taxable because some of it would be basis. I'm not going to go into the complexities, but those are a few of the things. There's some others. Oscar, are there things that you've seen?
Yeah, I mean, so, obviously when you're retiring, you're likely moving funds from various accounts, your 401k into an IRA. And sometimes, I've seen people take the check from the 401k into their own name individually, and then end up having to pay a huge tax because maybe they just weren't aware and they were just going through the paperwork. And sometimes the paperwork can be a little bit confusing. So if you don't know what you're doing, you can make a mistake and have a huge tax. Other than that, I think this is right on.
As you were talking, there was others. So I know another one we've seen is self-employed people missing the self-employed health insurance deduction once they're 65. So they're paying their Part B premiums and, they just didn't know that they could still take a deduction. And then we've also seen business owners, one unusual case where the qualified business income deduction was missed 2 years in a row, where it had been on the tax return in previous years. It was just kind of bizarre, but it was like a $24,000 tax savings for the person. So it was not a de minimis amount. So there's just, things that you have to look out for. Unfortunately, there's
Then
a
I got one
shortage.
more. I got one more. If you have a 401k and you've been making after-tax contributions to that 401k, right? So now, in essence, your 401k has pre-tax and after-tax funds. Normally, what we would do is say, hey, all the pre-tax funds, we're going to roll it into an IRA, and the after-tax funds, we're going to roll it into a Roth IRA. But if you don't do that at the outset, in essence, you're going to end up paying double tax on the same funds. So you just want to be sure that when you're making those moves, that you know what you actually have in your retirement accounts.
That's an excellent point. I hate seeing people pay double tax. It's the worst.
Somebody once said, I want to pay what's legal to the IRS, but I don't want to leave a tip. And I just kind of love that saying.
I like that. Wrapping up, we've talked about all of these. How do you locate assets in a way that consistently reduces the reportable taxable income using gain loss harvesting? We've talked about IRAs and withdrawals during low rate years, Roth conversions, and why it's important to draft a projection that helps you see where these opportunities are. Oscar, anything else you want to add to a wrap up before we open it up to Q&A?
No, the reality is there's a lot of moving pieces. And so, I think these takeaways are perfect. Try to lay it out. And then you all are gonna have little things that come up here and there that we probably didn't talk about. But just because we didn't talk about it doesn't mean that they're not there. So as always, consult with a professional, um, or just seek advice if you have any particular questions.
Love that. Um, well, we're going to open it up to Q&A. Nancy's going to come on and she's going to do her best to read all your questions. I also want to let you know our next webinar is going to be on October 24th. It's going to be on how to plan for healthcare costs in retirement. And we have redesigned our website. If you go to the Learn page, you go to sensiblemoney.com and the Learn page, and you scroll about halfway down, you will see a box where you can register for the next webinar. If you are signed up for our Financial Sense newsletter, which you can sign up in the footer of our webinar, then you will, or the footer of our website, then we will also always send out announcements of when the next webinar is going to be. Nancy, I know I've seen questions rolling in.
Yes, you have. So Dana, let me start with this is a wee bit over my head. Is there a good precursor program that explains more in depth the strategies?
Well, that's a great question. I mean, this is why there's financial planners and in retirement specialists, because it is very complex. So in terms of a course, no, I'm not aware of it. Michael Kitces does a lot of courses for advisors, and he does have a specific course that has, in case that is an advisor asking the question, we do get advisors that attend. He does have a specific course on tax planning. I don't know, I haven't attended it, so I don't know the depth it gets into in terms of retirement income planning.
What about the great courses?
The great courses, I mean, certainly my great courses, I talk about all of this stuff, much like we have today. It's broken into phases. So it's a little bit more life cycle oriented. What do you need to think about in your early years of retirement, your mid years, your late years of retirement? And definitely I talk about taxes. That might be a little bit more introductory.
Okay. Oscar, for you, going back to your comments on the 401k, what about plans that have both 401k traditional and Roth in the same plan, then roll over after tax into the Roth every year, sort of the mega backdoor concept?
What's the question exactly?
I'm not sure. What is on the question is what about plans to have both 401k traditional and 401k in the same, and I'm sorry, and Roth 401k in the same plan, then roll over after tax into the Roth every year. So you're doing almost like in-plan conversions.
Yeah, in-service distributions.
Not in-service distributions, but in-service
Intra-plan.
conversions. Yeah.
Yeah, that's a little bit of a new thing to be, the kind of the Roth and the Roth conversions inside of the plan. What I would recommend, I'm a big fan of having different buckets of funds when you retire. So having IRAs and Roth IRAs and brokerage taxable accounts, because that gives you flexibility. Because sometimes what happens is you end up with a big old 401k or an IRA, and some emergency comes up, and you have to take all the money that's taxable, and then at that particular point in time, it's a nice little hit. So I'm a big fan of diversifying your sources, but you also want to double check and say, hey, if I'm in a very high tax bracket now, it'll probably just be better to maybe not do the Roth. It all depends on where you are relative to where you're going to be down the line. If you're going to be in a higher tax bracket later, then doing the Roth, the mega Roth and all that, I think that's great. But if it's the opposite, where you're going to be in a much lower bracket, then you probably want to do as much pre-tax as possible so that you're getting the deductions that are more meaningful when you're in a higher bracket.
Mhm. I asked my CPA about tax harvesting. She made it sound complex and easy to do often. What variables need to be in place to do that? And I think you probably just want
Well,
to know what funds options you have,
mm,
and right?
you know, so there is something called a wash sale rule, and it was in our notes,
Mhm.
but we didn't touch on it today. And so the wash sale rule basically says, if you were to buy the same security that you sold, either 30 days before the tax loss or 30 days after, and so including the day of the sale, you have a 61-day window, then that can disallow the tax loss. So it's called a wash sale rule. And Oscar and I were talking about this before the webinar. If you have, you know, accounts in multiple places and they owned the same security, you could trigger that wash sale rule, and a part of your tax loss could be disallowed. So there is some complexity to it. But if you just own, a simple portfolio of funds and you're exchanging and they're all in one place and you didn't just buy those funds, then it becomes a little simpler. The other complexity that can come about is dividend reinvestment. So when you have dividends that are reinvested into a fund, that dividend reinvestment would say, oh, I just bought shares of that fund. Now I turned around, let's say 25 days later, and I sold it to generate a tax loss. Well, the portion that was just bought from the dividend reinvestment, that portion of the tax loss would be disallowed. So yes, there is always additional complexity. For some people, it is a very simple situation to do tax loss harvesting. For if you own individual stocks, for example, it's a lot simpler. If you run into some of the situations we just talked about, it can be more complex.
Another question, Dana and Oscar, regarding the planning itself. So before I do a plan, I want to understand the costs involved. Do you do only AUM, or is a fee for only the plan an option?
Yeah, so we have an unusual structure where everybody does a plan first for a fee. And generally that pricing is $6,900. It can be as high as $8,900 if it's a very complex plan with a lot of moving parts. But for the average person, we see that pricing at about $6,900. And then at the end of that planning process, you have the option to move into our AUM service where it's more holistic, and then we view it as our job to make sure that retirement paycheck that's laid out in the plan is realistic and ongoing and so on. And so we have people that do plans and that might come back later and then move into the full service. We have some people that will come back every few years to do plans. In general, we find most of the people inquiring are at some point looking to delegate. So that plan allows them to see the level of detail that we get to, and the level of sophistication that we bring. And through that process, they can decide, do they want to move into the AUM process or not? I really like that process. I have been in this industry since 1995. And that idea that you would have one meeting with someone and then here's all my money to manage, it always seemed a little backwards. So that the plan, is definitely a standalone option and allows you to really get to know us and what it is that we do.
And so someone is asking AUM question mark. So could you talk a little bit about assets under management? I should have used that.
AUM, sorry, we use our lingo. It's called assets under management. So it's a very common pricing structure for advisors where we charge a percentage of the assets that we manage. And in our case, it's what we call our juicing plus service. So our plans are called juicing. Our full service that includes investment management is called juicing plus, and that is at a percentage of assets, and it includes the ongoing planning every year.
Mm-hmm. More of a comment, Dana. Wade Fowles' book, Retirement Planning Guidebook, newest edition, is great for planning. I think this is a follow up to the question about resources. Also, retirementresearcher.com has an academy with lots of content. Emails and podcasts, YouTube videos are useful as well. So I wanted to mention that. Question, I'm in the transition period where work income is gone, but unfortunately holding a lot of tax inefficient funds in my brokerage account. I'd like to do Roth conversions, but assume I will have to first bite the bullet and sell some of those funds to get my taxable income down. Any other suggestions?
Oscar?
Well, I would just say that that's one of those things that you kind of have to see what it is that you are actually holding under the hood. Because sometimes we talk a lot about Roth conversions, but let's just use a very extreme example. Suppose you just have a bunch of uh, let's just say bad investments, right? That takes priority, right? To kind of safeguarding the nest egg. We sometimes in the industry we let the tax tail wag the dog. And so but sometimes we have to be a little bit more holistic and say, number one, what am I holding? Is it like potentially bad? And obviously we're not going to get into details here to make that determination because it might be that the risk management on the portfolio might be a little bit more important than the Roth conversion part, depending on what you're holding. Now, on the other side, you could do it little by little. Part of it is like if you have a tax projection like we've outlined, we can see where you're going to potentially pay 0% capital gains on some of those investments. And if you have that opportunity, take it. And the other thing that I mentioned earlier was if you if you contribute cash to charity, instead of selling the investments, paying the tax, and then contributing the cash to charity, you might consider just giving portions of those investments to charity directly and then reinvesting your cash that you were going to give to charity, but actually putting that into your portfolio. So in essence, you're getting rid of the inefficient investments, and then your new cash is going towards more efficient investments. So sometimes it's a trade-off, and you kind of have to run the numbers, and it's a case by case where you have to decide what's more important, the Roth conversion or the or kind of getting my portfolio into better shape.
So this
Yeah,
makes me.
and
Oh,
what crossed my mind as you were talking, Oscar, was just that, what would we have to know? How old are you? Are you single or married? What's your other sources of income, right? Is there a way you could prioritize, as Oscar said, get some capital gains at 0% tax rate now, and then maybe in 2 years do the Roth conversions? Like you just don't know without projecting it all out.
I find myself oftentimes saying one of my favorite quotes of yours, Dana, which is, you can do anything, you just may not be able to do everything, right? At the same time. Um, Question for you both on underpayment penalties again. How can you avoid underpayment penalties if you do a large Roth conversion late in the year and only pay the taxes due at the time the conversion is made?
So, okay, so yeah, there's a series of things I will say. Number one, sometimes just because you've made an estimate, so Dana mentioned this earlier, just because you made, so let's just use an example. Suppose you've made four estimated quarterly payments of $5,000 each, but your tax bill at the end of the year is 10,000 instead of 20,000. Then that means you overpaid throughout the year. And if that's your particular situation, and then you convert at the end, well, that's fine because you've covered your taxes. You've overpaid your taxes throughout the year. So in that particular case, you don't have to worry so much. Um, and then the second thing I would say is if your tax is less than $1,000 from all your various contributions, if the difference between your tax and your estimated payments is less than 1,000, you don't have to worry about the penalties. And then lastly, it's one of those things that, hey, if you make a Roth conversion towards the end, then you can't go back 3 months and make a payment, right? So you can only really go forward. And so I would almost like don't worry too much about what you didn't do. and then make the payment. Now, this is a good plug for one of the strategies we mentioned earlier. Maybe you take a distribution out of your IRA and have 100% withholding, and depending on the makeup of all your assets, there's a thing that we call the 60-day rollover rule that you can do once per year with your IRAs. So the way that would work is, suppose the tax you needed to send to the IRS was $10,000. So you take a distribution from your IRA, $10,000, but you have it sent directly to the IRS, 100% withholding. And then suppose you happen to have $10,000 laying around in your savings account or whatever it may be. You can contribute that back to your IRA, to kind of make you whole. So you covered your tax, and then your IRA is made whole with that 60-day rollover rule. So Dana, I don't know if there's
And
anything else you want to contribute to that.
Oscar, one other thing, and hopefully I'm not putting you on the spot, but would this be a case where you could allocate the income by quarter? So if that Roth conversion happened in the fourth quarter, or does income from the Roth conversion attributed to the entire year also?
Well, you could potentially do that. You could potentially do that, but normally, if you're going to choose to do the income by quarter, then it's best to do that throughout the whole year as opposed to switching up tax systems all the way at the end.
Got it. That makes sense.
Is a tax advisor separate from a financial advisor, or can one person do it all?
So they can be two separate things. What we see is when it's self-employed, business owners, I feel like tax advisors that have expertise in that space add a tremendous amount of value. When it comes to people and all we're doing is retirement income planning, a lot of the things that a tax advisor would do, we're not giving tax advice. We're simply projecting it out and telling you what's going to happen. Whereas a lot of times tax preparers are always looking in the rearview mirror at last year and just basing your estimated payments on the current year. So I've encountered practitioners all over the place, some that very actively do projections where, they do the projections that we would normally do. And all we're doing is sending them their estimates on capital gains, dividends, so on. They're plugging that into their model and they're working with the client. But I would say the majority of time I see that we are doing that kind of work. And oftentimes kindly, coordinating with the tax preparer to say, we don't think the client actually needs to make those large quarterly payments because their income's going to be less this year. Here's our estimates. What do you think? And so it's just the nature of if they're rear view looking, then they're not, seeing all the changes that are coming up that we are clearly aware of.
How many years out from retirement?
And one thing,
Oh, go ahead.
I want to add one thing to that. Is that, it's funny, I'm a CPA and I am constantly frustrated with CPAs because a lot of times they're focusing on that one particular tax year. They're not looking at the future tax year. Some do. So I'm not going to throw all of my colleagues under the bus, but I'm just saying that you want to be careful. It's rare that someone can just absolutely do it all. I think you can have professionals that are more versatile in that sense. But I've had a lot of encounters where we're doing Roth conversions, and then the CPA is telling the client that that's a bad move because they're paying more taxes this year than necessary. So sometimes they're just not seeing the big picture in some cases because they're just looking at the current year. So just be aware that that can happen.
Okay, so let me ask a couple of more questions here. What are the incremental tax factors and rates you use for long-term planning?
Um,
Well, I was going to say we use what's currently the system, which is like 10%, 12%, 22, 24, what, 32 or 35, and then 37. So they're published out there. We use what's currently in place, and then we use what we know is currently baked into the law that will change
yeah.
in 2026, unless something happens and it gets extended or what have you.
Yeah, so those rates are here. Um, the rates we showed in the basics section inflated every year, and then we're assuming that under current code they go up in 2026. So that's what we're currently using.
Okay, when is the next class?
The next class, let me get back, is October 24th. It's on planning for healthcare costs in retirement. And I will have two guests joining us. One joined us last year that works specifically in the Medicare, healthcare, and Affordable Care Act space, and another one to talk about long-term care. And so that will be, as we said, October 24th. At the same time, we're going to do this 1 p.m. Arizona time, which is 4 o'clock Eastern time.
You touched on how cash flow can influence asset location, but how do you decide which type of account to withdraw from for regular cash flows and expenses?
We use that tax projection model that shows us how much income flows into which rates. And then, it's like a jigsaw puzzle. So, right, we might say, oh, I have this opportunity to take out more from the IRA this year. And so we're filling in that jigsaw puzzle. As we describe it, we're solving first for all the non-investment levers that can improve the outcome. That might be Social Security claiming when you do deferred comp, the asset tax efficiency of how the portfolio is structured, where withdrawals are coming from. So we've laid out those withdrawals to first be, the way that looks like it's going to save you the most taxes over your retirement years. And then we're aligning the portfolio up to that withdrawal pattern.
What is your assets under management rate?
It starts at 1.25%, and then it tiers down as the asset level goes up.
Talk about life insurance as a legacy tool, as an income tool. Is it something that makes sense?
Well, I guess it always starts with, do you have current life insurance? Number one, and do you need life insurance, right? Um, that's a different question than should I buy life insurance if I currently don't have any? If you have a policy and it happens to be a permanent policy, um, what we have done in many cases is we say, hey, we may not necessarily need the life insurance component as much anymore because we have more savings and investment accounts. So if I passed away, my family will be taken care of. But what becomes a little bit more of a concern is, as we age, is long-term care. What would happen if I need to go into a nursing home or assisted living or what have you? So if you happen to have a permanent life insurance, oftentimes there's something that we can use called a 1035 exchange from the tax code to potentially transfer that policy into a policy that has long-term care benefits without any kind of income tax. So that's something that can be done. Now, the other side of that question was about the income part of it. And all I'm going to say there is, some in many cases, uh, the initial illustration that you might receive from a life insurance agent kind of looks very rosy and beautiful. But when you actually buy the product and you go to use the income years later, it's not what you thought it was. That's been my experience. I'm not saying that it's a bad strategy. I've seen it used semi okay, but in many cases, what the income you thought you would be able to pull out later is not what you can actually pull out when you actually get there. So, Dana, I don't know if you have anything else to add on that.
I agree with everything you just said. I'll say, there are cases with very large estates where, life insurance can form a function of, helping to pay the estate tax on a closely held business or a farm or an asset that you really don't want to have it be liquidated to go to the next generation. For the average retiree, we don't see those scenarios. And so that makes it, a tool like all tools that have some very special use cases where it works really, really well. And then a lot of other cases where, maybe it's not the ideal tool for the job. And so it really has to be evaluated, yes, everything we say on an individual basis. Oscar, any thoughts on this one? Are there any general rules for the best time to get married to save taxes? 162-year-old, 160, not taking Social Security yet.
Well, the first thing I will say is, I mean, Dana, you and I are both married, and I think we would probably both agree. Number one, don't make a marriage decision to save taxes. So let's probably get that out of the way, right? But beyond that, if you're already like, hey, this is what we want to do, the reality is, when you're filing tax returns, right? Like if you get married like December 31st, like at the last day of the year, even though it's like one day for that year, you could actually file marry filing jointly. So if you're looking at that and you're towards the end of the year, like you don't have to get married on January 1st to be able to file marry filing jointly. So from that particular perspective, as long as you get married within the year, you could already start reaping the benefits of some of the tax bracket advantages that married couples have over single couples. So hopefully that answers. Dana, I don't know if you have anything else to add on that.
No, I mean, we've done this analysis for many couples, and that is a complex situation because we have to run it privately or privately. We have to run the projection like as if they're both single, and then at a certain year they become married, and it changes the tax rates. And then we have to combine the results. In many cases, I would say most cases, there is tax savings to getting married, but not all. And so, as your income goes up, if you had one spouse that had no income and one spouse that had income, there can be some cases in there where it's not a tax savings, but it's very rare. Most of the time, there's a tax savings to getting married. I see a question, am I hearing one can pay all their annual taxes at the end of the year? So this has come up a few times, as we were saying, if you withheld it all from the IRA distribution at year end, then that is considered as if it was paid throughout the year. Oscar in our conversations called it one of the last freebies that you get. So yes, believe it or not, that is possible. What Oscar was just talking about in terms of the December 31st was if you got married on December 31st, that would allow you to, file married for the whole year. I got that right, Oscar?
Yep.
Yeah. Okay. The last question, I'm going to address, and then we're going to wrap, is does your website show a sample of a juicing plan or more details? We do complimentary introductory meetings, and those run usually about an hour and a half in length. After that meeting, we send you links that you can download and look at samples. We're not salesy. There's no cost or obligation to those meetings. So if you want to take a good look at that, we would say, fill out our pre-meeting questionnaire and you can set that meeting and certainly learn more. But they're very comprehensive. I've had other planners go through them. One recently, she is, near retirement age and was just, she was astonished at the level of detail that we got to and how useful it was versus the typical planning that just kind of shows you a graph and says, yeah, you have a 98% success rate. No, you have to get down to the granular level of detail of what year and month, are these various cash flow sources going to turn on and off and how much is going to taxes and all of that. So, to do that transition right, that granular level of detail is certainly needed. Thank you, everybody. Our apologies if we didn't get to your questions. I know Nancy goes through the questions afterwards and tries to follow up with them one-on-one, but we really appreciate all of your time, and hopefully we'll see you again on the next webinar.
Yeah,
Bye,
everybody.
everybody.